Good morning, students. So we were discussing about capital market. We have discussed about primary market and secondary market, and we have distinguished primary market and secondary market. We have distinguished capital market and money market as well. So, capital market. In today's session, we are going to brief about capital market instruments. But in the next few classes, we will share notes by preparing PPT, by sharing PowerPoint slides so that you can make down your notes. So capital markets, capital is the minimum fund required to start any business or any amount required to initiate your business activity can be called as capital. So what are the sources of capital first of all? So if you say capital, this is your capital structure. So under this capital structure, you have equity shares, you have preference shares, you have debentures or debt. These are primary instruments of capital market. But what is the difference between these things? See, preference shares and debt, the return on investment. So if you issue, you need a capital of 100 rupees. 100 rupees the minimum amount required to initiate your business. So this 100 rupees considered as capital. So this capital 100 rupee capital, you are issuing 50 rupees worth equity shares and preference share worth 25 and debenture worth rupees 25. So altogether 100 rupee capital you need. So for preference and debenture or debt 25 rupees, you are paying fixed rate of return. So in your class 11th and 12th also, in your balance sheet, you might have found that preference shares, they will give 6% preference shares. That means 6% is the kind of interest or return on their investment. 6% you have to pay them back. So if they are investing 1 rupee, then you have to pay them back 6 paise as a return on their investment. And debt, it is the loan. So loan also it bears interest. You have to pay interest plus principal amount while paying back your loan. So these two, before starting your business itself, you know what you have to pay them back. What is the proportion or what is the percentage you are going to pay them back. But equity shares, you never know because equity shares, listen carefully, equity shareholders are considered as owners of the company. So equity shareholders entitled to get part of the profit you earn in your business. So since they are entitled to get the part of the profit. They are entitled for the profit earned by the company. They are considered as owners of the company. So when you earn profit, say for example 100 rupees your profit, you pay preference. See, shareholders are entitled to get dividends. Dividends are nothing but, see, these are the two marks, very important topic and questions. What do you mean by dividend or define dividend? So, dividend is the part of the profit earned by any business which is distributable among its shareholders. Fine, we call it as dividend. So dividend is that portion, part of the profit which is distributable, which should be distributed among its shareholders. It means these companies. So 100 rupee profit, you pay 20 rupees for preference shares because preference share also bears and it contains fixed rate of return on their investment. So you pay 20 rupees for, sorry, you pay debt 20 rupees, interest on debt 20 rupees. You pay, debt means debentures, loan borrowed from bank or someone else. So if you borrow loan, you have to pay interest. So first of all, if you earn 100 rupees as a profit, you are paying 20 rupees as a interest on your loan. So this is interest on loan. Remaining 80 rupees. Remaining 80 rupees, again you have to pay 20 rupees as dividend of preference shares. Dividend on preference shares, you are paying 20 rupees again. So out of remaining is 60 rupees. So remaining is 60 rupees profit, which must be, say for example, there are 10 shareholders. There are 10 number of shareholders. So you have 60 rupees which must be equally distributable among equity shareholders of the company. So how much are the shareholders? You have 60 rupees, you have 10 shareholders. So each equity shareholder gets rupees 6 as a dividend. So dividend is nothing but the part of the profit distributable among shareholders. Number of shareholders of the company is called as dividend. Now, the capital formation or structure of your company's capital is you need 100 rupees as a capital. You are issuing equity shares worth rupees 50. You are issuing preference shares worth 25. You are issuing debenture or you are borrowing loan amounting to rupees 25. This is how you form your capital. So capital is that amount or minimum amount required to initiate or to start business. So while classifying, categorizing capital market again, please remember what is capital market. Capital market is the place where long-term funds are invested and borrowed. Fine. So long-term and medium term, in the sense borrowing and lending takes place for the period of more than 1 year. That is considered as capital market. Now, if we categorize capital market, one is ownership securities, another one is creditorship securities. That means, see simply, say for example, if you want to buy a car for rupees 1 lakh, for rupees 10 lakh, fine. If you are going to buy a car worth rupees 10 lakh, you have rupees 5 lakh with you. You have 5 lakh. And remaining 5, say, you have 6 lakh. For example, you have your seed. The illustration is you are going to buy a car worth rupees 10 lakh. You have 6 lakh in your pocket and remaining 4 lakh you are going for EMI or you are borrowing from certain financial institution. Now this remaining 4 lakh. Now, since you have 6 lakh with yourself, that is your money, this portion is considered as ownership portion. That's what here is. So, you see, the car worth 10 lakh, you are owning to the extent of 6 lakh, right? Because you are paying 6 lakh as that is your own money. That's what ownership or shares. Now remaining 4 lakh, you are borrowing from a bank. You are borrowing loan. That's why it is considered as creditorship. Credit, it is a loan. So the 4 lakh worth you are paying by EMI or you are borrowing from certain bank or financial institution. So this portion is considered this portion of the capital. See, match with this thing and this one. So here is the illustration. If your capital requirement is 10 lakh, you have 6 lakh your own money. That is ownership, and remaining 4 lakh you are borrowing from the bank, that is the creditorship securities. That's why we call this as debentures. So in next class onwards we are going to discuss all these instruments individually in detail, because these things are they play very pivotal and primary role in commerce career. So thank you.